FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
This episode of the Financial Survival Network is brought to you in part by Sandstorm Gold Royalties. Sandstorm Gold Royalties is a different kind of gold company. They purchase royalties on select mining operations and receive a percentage of the revenue in return. Sandstorm now has a portfolio of over 185 gold royalties around the world. See how gold royalties differ from other gold mining investments at sandstormgold.com. That's sandstormgold.com. Sandstorm Gold Royalties trades on the TSX as SSL and on the New York Stock Exchange American as SAND.
Welcome, and you are listening to the Financial Survival Network. I'm Kerry Lutz, and it's Halloween. Happy Halloween out there. Don't eat too much candy. You know, candy is just not what it used to be. It used to be you went to the movie theater, you got Reese's Pieces, you got M&Ms. It had real chocolate in it. I don't know if my taste buds are getting dull or dimmed now or just not as responsive. I have nerve damage in my taste buds, my olfactory bulb. I don't know what it is, but this candy just really doesn't taste good. And when you look at the package, it doesn't say chocolate anymore as the active ingredient. It says, chocolate butter or confectioner's sugar or something like that. I don't know. But if you feel that way, or if you want to be part of the show, just email me, kl@kerrylutz.com. You know the old saying, it takes one to know one. And if you can't beat them, join them. Well, next person you're about to hear from believes that the world's most successful investors are the bank owners, and that you too can become a successful investor by simply following the leader, following what they do. There's certainly a lot of truth to that statement, and really, who can argue with that? The banksters run the world. One person I once heard speak, Doug Casey, said, if you want to succeed in these markets, you need to think like a thief. Oftentimes, there are many of you out there who believe there's not much difference between a bankster and a person that makes their living through nefarious means. But we'll let you hear about it directly from the source. Stewart Thompson, you are editor of Graceland Update, which deals with macro markets and how to profit from them. Hey, welcome to the show.
Thanks for having me, sir.
Hey, so you've been doing Graceland Updates first. That's an interesting name. How did we get that?
Well, a lot of the gold newsletters have to do with gold, and I did cover some other markets, and I was always an Elvis fan as a kid, and then just kind of the word grace in there. I just thought it was a little more mellow approach to the general markets. Mm-hmm. And so that's really where it came from.
Very interesting. Well, I like the concept. It's got a nice ring to it, I will tell you. We're into branding here on FSN, and it's an interesting brand. It makes me curious. Is it Elvis? What is it about? God's grace, or maybe a combination thereof. Hey, so your whole philosophy here is that the banks know what they're doing. The banks always make money. So if you follow them, you'll achieve similar results. How does that work exactly?
Well, I guess I used to work as a broker, and I started out, I was probably one of the younger precious metal investors. I was the richest kid in high school. I'd invested in gold and silver in the early 70s when I was only 8 years old. I used to take a wagon around and get pop bottles and mow lawns, do whatever I could, and I put it all into gold and silver coins. And then I was living in Vancouver, BC at the time, and my father subscribed to the Harry Schultz newsletter.
Oh, got it. Yeah.
And so I used to sneak it off his desk at night and read it, and that's how I got my interest in the gold. And So in 1979, 1980, I was starting to wonder when this was going to come to a peak. And I was in Hawaii, actually, on the day of the peak. Silver had hit $50. And I was looking at the news, and it was on the news. And I told my mother, I want to take a plane home. I'll pay for it. And she said, well, it's a family vacation. You're not going anywhere. And I said, but I have to sell. It's going to crash. And so what first thing I did when I got back to Vancouver, I put everything in a big bag and went downtown to what was called Monarch Coins, which was originally a small coin shop. But with the boom, it had just become enormous. And they actually had a buy and sell line in the place. And I was the only person in the sell line, and the buy line extended about a block down the street. And I just got out of there because the people looked at me. They were hostile. It was like, what's he doing selling? Doesn't he know he's supposed to buy? And I said, they almost look violent. Let me just get out of here and take my money and run. Yeah. And so that's what I did. And then I ended up becoming a broker. I studied English. I was, pretty good at English in school. I studied Shakespeare in university. And so the writing came about between the investing, and that's kind of how I've got sort of the unique thing that I do with the newsletter. But in regards specifically to the banksters or the banks, as a broker, I began following the COT reports. And
that's the commitment of traders reports, correct?
That's correct, and it really shows the retail traders are in there as well, but the big groups are the leveraged hedge funds and the banks, and they put the report. Really, in today's age, and this is another argument that things aren't quite right with all these markets. You should be able to see a commercial trader's trade instantaneously, but we get these COT reports every Friday showing the action from Tuesday to Tuesday.
Yeah.
Well, the banks see all the action right away, so they're on pretty much every trade you see on the COMEX in gold and silver. The banks are on one side, and the funds are on the other. And some people have argued that the banks sometimes pose as funds, so they're taking both sides of the market to manipulate the price. I think it probably happens at times. I think also the big thing that banks look at is the physical market out of China and India, how much, because the mine supply is pretty stable unless there's a big change in central bank or something like 2008, a big change in Western investment demand. It's pretty much the change in the physical market that moves the gold, sort of that $100 move, that sort of an intermediate trend. And their actions on the COMEX seem to magnify everything that happens. So what might be a $10 move down in a physical market where demand's kind of softening becomes a $100 move or a $200 move. And the banks seem to always be the ones booking profits on the short side when it goes down and selling on the upside when it goes up. And so I developed some systematic ways for small investors to basically chisel into the market when the banks are doing that in the COT reports. And then I'll use various technical indicators and especially big support zones, big moving averages to sort of tweak that and do a little bit bigger buying in those areas. And then I run a swing trade service that's very, very short term, where you could be out in hours, but typically a few days to a week or so. And that's not based on the COD reports. It's just the swing trading that I try to get investors. It's demoralizing, especially as in some what I call a non-approved asset like gold or Bitcoin, where governments don't approve of these assets too much, at least in the hands of the citizens. And so any kind of nefarious things that go on in the market, they kind of seem to get ignored. And if anything, you see the sort of approved markets like the stock and bond markets and the fiat currencies, if anything, a little bit manipulated to the upside. So, basically what I'm trying to always do is look for an angle around that.
So what do you think is happening in the gold market right now? So that's your primary focus, or?
I would say that the stock market, the gold market would be slightly the main focus. When I was a broker, what I would tell new clients is start with not what's the most exciting in the market right now, but start with managing risk, and reward will take care of itself. So the first item to buy is the lowest risk item, which is gold.
Yeah.
Then look at bonds, T-bills, that kind of thing. Then move into the big blue chip stocks, the Dow stocks, and then into the more speculative stuff. And so you're building your pyramid up, your investment from starting with the least amount of risk. And as far as the gold market goes right now, you had this big deflationary wave from 1980 where interest rates, have declined from basically 14% on the T-bond. And this has created this huge sort of deflationary wave and stock market wave. And I think that's ending now. But you've kind of got this conflux of the rise of China and India, which is where you have gold being bought just based on the increase in the standard of living there. And India is coming from a tremendously low level. I mean, just a year or two ago, your average person's making, $20 a month or something.
Yes.
And so you have this huge class of citizens over there. Now, that's a bit longer term. You get 600 million people in India under the age of 35. You're only going to see demand slowly rise from those areas. And then here, you have a number of things going on. You've just got this long interest rate cycle down, turning up. And at the same time, you have this big QE money ball, as I call it, sitting in the Japanese central bank, the European central bank, and the U.S. central bank. Now, with rate hikes and the start of quantitative tightening coming out into the financial system. And so this is an inflationary force. And so these things, I think with gold, when we came down from 2011, the sort of where you had this system risk fear trade going. And I talked about a long period where gold would just kind of trade sideways. And that's sort of what's happened. And from a technical perspective, you could argue there's a huge head and shoulders bottom on the gold market. And I think you're basically making this transition where you're looking at money velocity, inflation, the services sector versus sort of deflationary goods, all sort of pushing prices to the upside. And then you have also this government debt that gold bugs are, debt and gold bugs are they go together. And the U.S. government debt, I think a lot of people what you have now is as Trump has increased the debt, you could argue it wasn't really him, it was just the government itself. It was going to go up anyway, regardless of who got in. But that's putting pressure on the yields at the same time as the Fed is just outright raising rates, and this quantitative tightening is putting more pressure. So you have all of this pressure on interest rates, and I think you're at a period somewhere like 1966 to 1970 in the West. But you didn't have this big QE money ball then, so it may not be sort of the 14-year wait to get to much more significant inflation.
I think the promised land, the promised land of gold bugs. So
that's sort of what they all live for. Is this big?
Is it really going to happen? Is it really going to happen?
I think it probably does happen, but not in the time frame that everybody wants it to happen.
But it's going to happen.
Well, it's happened throughout history for thousands of years, but it tends to happen usually decades after people think, in 1980, people thought there was too much debt. Now we're almost 40 years later, and the U.S. dollar is still the big currency, but the de-dollarization of, these are long processes. So I think what you're seeing as China and India come up is gold becomes more of a respected asset. And you see people like Ray Dalio talking about gold not just as a hedge, and that's kind of the fear trade word, but as a portfolio diversifier. And some pretty good statisticians have done work going back to the 70s suggesting that in a portfolio with its 50% bonds and 50% stocks, adding 15 to 20% in gold and dialing down the other portions would actually have outperformed and given you less volatility overall. So whether that number is probably too big for most people, but I think there is a changing of the guard in gold from just really a hedge to sort of a more respected asset. And again, I think that's only beginning right now.
It's interesting because logic would dictate that we're going to have major inflation, right? It's just common sense that it would be, and yet we haven't seen it. Yeah, we've seen inflation in terms of the Austrian School of Economics, huge inflation of the money supply. We've seen inflation in real estate. We have seen inflation in collectibles, in the collectibles market. We've seen huge inflation in terms of financial assets. The only thing where we haven't seen inflation is in gold. We've seen consumer prices for commodities not go up, but consumer inflation price increases for things like insurance, for health insurance here in the States. I know it's free in Canada and you don't pay anything for it other than your taxes, but here we've seen it go up, and we've seen increases in rent, which doesn't get figured into the CPI directly. We've seen increases in a lot of things, but yet there's this perception that prices are stable.
Yes, and I think some of that you could argue, again, going back to sort of the COT reports, you see so many times when some kind of price driver for gold makes it into the mainstream media, and gold, say, has a $100 rally, well, then it tends to give it all back, if not more, when that catalyst ends, which you don't really see with other markets where it's just all taken away again. You see that a lot in the gold market where there's a rally and then it's all gone again. And the smaller gold stocks, I mean, if you look at the CDNX index of the venture stocks, which is where most of the, sort of the most junior miners are, I mean, that index really peaked out in 2006, 2007 when gold was 700. You go back to 1900 a few years later, and the index is nowhere near its highs. And this is demoralized because a lot of the gold community has been involved with these little stocks. And you could argue that you could go to 3,000, 4,000, 5,000, and the CDNX would still be struggling to make new highs. I'm not saying that happens, but it could happen. Another issue is that the excess reserves rate
on deposit with the federal.
The Fed keeps hiking that as it's hiking the Fed funds rate, and it claims it's to maintain control. This is slowing the movement of money into the commercial system, and I think if you get more of a disconnect there, you'll start to see instead of this, we're barely today they put out news we're at 3.1% in wage, the biggest in 10 years. But how big is that really when you look at, as you've mentioned, all these other increases that people are paying? I mean, your standard of living is, or at least your purchasing power has been demolished for the average person.
Absolutely. So interesting. So that's a form of what they call in monetary policy parlance, sterilization, where the newly created money that shows up on the balance sheets of the nation's big banks, big banksters, basically gets put on the rocks, but gets put on ice. But now with interest rates going higher, that's usually when inflation picks up because it's more profitable to make loans. We haven't seen loan demand. We haven't seen loan creation at commercial banks really take off. So what other ways can you act like a bankster and cash in on their control of things? I mean, that's really the theme of your website, your newsletter, and that's what really intrigued us about it.
Well, you also want to own the approved assets. And in 2008, that was one of the tougher times for me to buy into a declining market. And this tends to be what you see with sort of these approved assets, is that when you buy it, as a value investor, I was buying into the tick lows of 2008. I didn't enjoy it. Uh-huh. But because I knew as we were going into October there in 2008 that some of these Dow stocks really could go off the board, and either the Fed was going to print money or we were going to end up like 1929. And I just didn't, and then they came out and announced the QE program and everything turned around. And I mean, I was literally sitting there at my desk holding my stomach, pushing the buy button. And the next thing I look at the screen and it's like some of my orders are already into the sell zone, like in minutes. Yeah. And that was the QE announcement. And so I think, it's another thing that's tough for gold bugs is, most of them tend to be libertarian or at least Republican. And so when Obama was in there, it's tough for the average gold bug to buy the U.S. stock market in that situation, even though you had the business cycle at a trough.
Right.
And now you're kind of rising up to at least sort of approaching a peak. And you could argue that QE has extended the cycle, but you're kind of at the higher part. But then you have, the gold bugs like Trump, and he's in there. So you kind of think, well, maybe this can just keep on going and everything will be wonderful. But you're sort of facing off against some of these institutional money managers that are just sort of really seeing this as getting later and later into the cycle. And but generally speaking, the big assets are gold, real estate, currencies, the stock market. As a gold bug, just as you hear a mainstream investor like Dalio saying, put at least 5% of your money into gold, or the Shark Tank guy, he's a Canadian, Kevin O'Leary.
Yeah.
And
he's a little checkered. His past is a little bit
interesting
checkered.
Fellow, but he has two things that I endorse. I run a dividends letter as well, and he won't buy a stock that doesn't pay a dividend, at least a mainstream stock. So definitely you want to look at you could argue that about 70% of the market's gains going back over the last 50 years have come from dividends.
Yeah, reinvestment thereof, right?
Yeah.
That's proven.
Yes.
And we're talking the dividend aristocrats, basically. But you can find these aristocrats all over the world, right?
Yes. And not getting carried away with just reinvesting into one stock that's doing well, like, say, GE or GM at the time. And
yes,
you could be and then it all just, it doesn't really help if you reinvested it all and then it melts away. But
correct.
Those reinvesting some of those dividends. But just as the mainstream investors use gold as a hedge, gold investors should own the stock market as a hedge.
Correct.
So it's just that contra.
You're so spot on here. I made these mistakes myself. I'm very transparent about it. And I thought it was the end of the world in 08 and 09. Stocked up on gold and silver. It did great. And I thought it was just going to keep on going and going and going. And then 2011, I found out I didn't really know anything. And I'm not embarrassed to say it because this is part of the learning process. But how do we stop making the same mistakes over and over and over again, Stewart? That's really the question.
Well, that's where you have to divide. You really have to sit down and, maybe somewhere in the range of 20% of investment capital towards real estate, 20% towards fixed income, which right now would be really short-term bonds. You don't want that long-term risk in the 30-year T-bond or even the 10-year, but and the yields are low now, so you basically have. You have system risk, but your risk holding the bond isn't very much. And then, another 20% in the stock market and 20% in the gold. So you're kind of got these 4 or 5 pillars that you're sitting on, and you want to set, that's what I call my pyramid generator. So you want to be a buyer of these items on weakness. So you would probably go in and get a core position in each of them. And this is where emotions play a role. If you don't buy enough and it starts shooting up, you'll end up chasing after it, and then it falls down and you get hurt. Yeah. And if you buy too little, well, you just don't make anything and it goes up. So you really want to have it's hard for investors to be realistic about what amount of capital is really best for them as a person. And not everybody's the same. Some people are wild gamblers, and they, as long as they know that, they can be happy in the market, whether they're winning or losing, quite frankly. But for somebody that's maybe a senior citizen that's seen these interest rates come down, and then you go and throw all your money into real estate in 2007, some kind of, vehicle, and then it all melts away. It could be absolutely traumatic. Or junior gold stocks in 2010. I called that October of 2010, which is really when the gold stocks peaked in that cycle.
How'd you know?
Well, because I was getting the peak emails I received from gold bugs in October of 2010 was 666 emails.
Really? That was
what a number. Huh? I really couldn't believe it.
Amazing.
And I thought I renamed that time period the loss of sanity highs. And it just, there were so many people sending me so many emails with so many junior gold stocks they held, and just buying more and more.
Right.
That it seemed to me that nobody was really was thinking of it as a portfolio anymore. It was just a frenzy. And there was a bit of that in the stock market here right before the latest slip.
Yeah, so let me just go over another one. We haven't mentioned it. I didn't hear you say it, but I presume that you probably had some involvement, Bitcoin.
Yeah, I was. I started following. I wasn't the earliest guy. I had one of my newsletter subscribers put me on to Bitcoin, and it was around $50 then, and I didn't do anything with it, but I started covering it in one of my newsletters, and I write in a Bitcoin newsletter, GU Blockchain now, and I guess at about $100, I started buying it. And then people were, there were people mining it on their computers. I wasn't really a big tech guy. My father was an engineer, but somehow I didn't quite get all of his
you didn't get those
engineering skills. But so away we went with the Bitcoin. It went up to 1,000, and I told people buy it every $25 down. From $1,000 to zero, and it went down to 100. And remember, Litecoin went to $1.
Yeah.
And so we bought, and then it took off. And you just don't know when that's really going to happen. They don't all take off like that, but Bitcoin certainly did. And in the case of Bitcoin, unfortunately, I think that once it got into the mainstream media, I don't think it was so much a case of the public buying maniacally. And in the beginning, the Edwards and McGee classic charts worked perfectly like they did in all of the markets until the banks get involved with their algo programs. Mm-hmm. And Bitcoin, if there was a little head and shoulders bottom, you knew it was going to make a rally. If there's a little top, it would go down. And
yes,
it was all just pretty normal. And then you got, it was all over CNBC, and people began saying, well, that's when you saw the establishment, Jamie Dimon, or Jamie Demon, as I sometimes accidentally call him.
Demon. Oh my God, you're so cynical. Hey, and I totally get what you're talking about, and I could talk to you all day about it, honestly, Stewart, but we don't have all day. But I want you to know about Stewart's site, which is gracelandupdate.com. Tell us the dividend stock site also, please, Stewart.
That's gudividends.com. There's gracelandjuniors.com for those that are interested in those stocks. And there's GU Blockchain for the Bitcoin people. And then there's GU Swinger, which is for the swing trades, the aggressive swing traders, leveraged ETFs, its futures, etc.
Very cool. Hey, I really enjoyed talking with you. You got such a great perspective. And hey, where are you out of? Are you still in Canada, in Vancouver? Or are you elsewhere now?
I'm just outside of Toronto now. Been there for the last 20 years.
All right. Well,
I miss Vancouver, but I do want to thank you for having me on the show. I certainly appreciate it.
It's a total pleasure.
Thank you, sir.
Hey, when you need some warm weather, come down to Palm Beach County, Florida. That's where it's all happening.
I might be down there this afternoon.
In your winter, well, you're suffering through winter and wishing you were 6 feet under sometimes when it's that bitter cold, and I know it. I lived in New York my whole life. Think of warmer pastures, sunnier places. Hey, be a part of the show and write to Stewart. Check out his sites. I guarantee you it's going to be worth your while. Absolutely. Hey, the email address is kl@kerrylutz.com. Our Twitter feed is @KerryLutz. And our Facebook page is Financial Survival Network. Stewart, you are going to be on the regular rotation from now on, I promise. Let's talk soon. You be well.
Thank you. You too, sir. Thank you.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.